All right. Welcome. It is January 21st, 2015. Jamie Saettele here with the Midweek Strategy Webinar. And we'll just get started here in a moment. All right. First of all, let me begin with, for some reason, if you're watching this archived, I don't know why, but you might not see the mouse for whatever reason. I have no idea what's going on. Mike and I do these webinars on the same computer, and for some reason people can see his mouse during the archives, but they can't see my mouse. If you're watching it live, I think you can see the mouse because everyone tells me that they can, and I have no clue. I sat here for the last hour looking through the help pages and everything else, and I don't know what the deal is. So I do apologize for that, and we'll keep trying to figure it out, get somebody on the phone with GoToWebinar or whatever, but I just want to preface that first. And then Sandeep has a question about the leverage. Yes, so I've been meaning to put out something on the site that has like a little more detailed explanation or an explanation on that. So when you have in the leverage part, right, first of all, there's obviously two kind of ways that we put trades in. One is here on the orders. Another one, of course, is on Twitter. When I'll, say I'll highlight levels that we're looking to go long or short and all that, following it specifically, the watch list, these are usually the ones that are going to be better trades, I feel like, at least lately, because you can get real precise on the timing. The Kiwi dollar this morning, for example, short, we had 76.80, 77.10 estimated resistance. We traded 77 this morning, and get the idea. So with the leverage, look, only you know your financial situation, and only you can decide how much you want to risk. Inherently, a closer stop is going to afford you a larger trade size, okay, than a wider stop. The risk on that is that when you have a closer stop, you're more likely to get stopped out by noise or whatever. I mean, that happened with the Aussie trade last night, right? The Aussie entry was 81.90. We're trading below 81 right now, but the 82.20 stop was hit. The high of the day was like 82.35 or something, and the Aussie, was ticked out. So you need to decide. What I do here, provide leverage, is meant as, a multiple. Okay, so if you regularly trade, I don't know, if you have $10,000 in your account and you regularly trade at 5 to 1, risking at 20 pips or something a trade, that would be like a 1% risk, and these are just consider them kind of confidence levels. Right? So if it's a 1, it might not be as confident. If it's a 2, it might be more confident. If it's a 3, it might be more confident. Right? So that's the best way to explain it. This isn't obviously the end-all, be-all. There's no magic formula. Try to do the best we can with providing solid, actionable ideas. Obviously, this is the stuff that we trade as well, but it's not robotic. Okay? We try to, in this page, try to indicate times when we see good opportunities to maybe step on the gas a little bit. We were looking for this Aussie move, for example, the one we got today. It just unfortunately came after the overnight chop fest, ticked us out at 82.20. Of course, Kiwi ended up working out really well there. So, again, we'll try to put something together But everyone's unique. Everyone's financial situation's different. Some people are in this for different reasons. Some people want to try to make it rich, obviously, really fast. That's probably not going to work. Some people are in it to try to make, 20, 30% a year. Some people are in it to, whatever. So everyone's going to be different in their in how much leverage they want to employ. Okay, but I would suggest using this as a guideline as to what, as to a position size to trade. To give you an example on my own trading, I'll typically trade, with the size of, say, 5 to 1 on most entries. So again, if you had $10,000 account, it'd be $50K per position. If I have 2, it might be $100,000 on that trade, right? It's just a good example to give. All right, so we'll move on from there. I want to start with the Kiwi just because it's something that's going on right now, obviously. We'll go on to dollar yen from there and some other stuff. So, Mark, another question. Are watch list pairs meant to be actionable if note conditions are confirmed? Yeah, I mean, look, you're your own person, okay, and you have to decide what you want to, what you're comfortable doing. I mean, Kiwi obviously was something we watch closely. I rarely put, red squares or blue squares on a chart. Most of them are yellow just for reaction level. So when there's something red, you know that it's something that I'm looking at quite closely. And then obviously all morning I tweeted out about Kiwi and looking for 77 resistance, et cetera, et cetera. So, yes, it happened so fast, to be quite honest. I mean, we got the spike in there, and within 2 minutes, Kiwi had fallen like 50 pips. So, it was kind of one of those things where you had to jump on it really quickly in order to get the proper reward to risk on the trade. Let's get into that Kiwi, though. So, with Kiwi dollar, been talking about it in the last few webinars. We do have what I think, could be a larger breakdown underway. Again, this was the overnight chart on the hourly. And then, of course, we had this is what happened, okay? Traded into that zone, and the thing just, reversed like a bat out of hell. So, within literally an hour, the market had traded basically from a range to a breakout, and we are now at levels we haven't seen in a while. This is December low, 76.08. So if we take a look at some bigger picture charts, right, where can we go from here? The first big level, I think, is probably the 73.70 area, okay? Now, this is a monthly chart, okay, but it does convey just how, big the next levels that we're going to get into are. If you look way back, you can see highs back here in 2005, up near 74.60. There's a spike high all the way back in 1988. By the way, the free float in the Aussie and the Kiwi was over here in 1986. We've got those levels up there at, what's it, about 72.30. Okay, and we have what could be a lower parallel support line that intersects basically down near the 73.90, 73.70 area. 73.70 is the November. Can you guys see the charts? I just had someone say they can't see the chart. So, okay, I can, okay. Chintan says he can't see the charts. I'm sorry. But I'm getting a lot of responses that everyone can see the charts. So you might want to try just perhaps restarting the session. Again, this will be archived too. But yeah, everyone it seems can see the charts at the moment. So the next big levels, it does seem, would be 73.70, 73.90, okay? And again, that's the gap, 73.90 from November 2011 after Thanksgiving. It's also the November 2011 low. Okay? So that would be the next first test. Now, what happens after that, if we break 73.70, that makes a huge double top with the 2011-2014 highs, and the target for that is all the way down at about 59, which happens to be pretty close to the 2004 low and the 2006 low as well. All right? Not going to worry too much about that at the moment, obviously. We're going to worry in the near term and everything. And I'm going to show you some stuff about how to get involved with this breakdown trade if you're not already in it. But another reason why I really like the Kiwi on the short side, just, a very simple kind of thinking about supply and demand, right? Markets go into trend, they go into consolidation. If everything from September is a continuation pattern of sorts, okay, one, it's extremely bearish continuation pattern because the continuation pattern itself is downward sloping. Okay, remember for a while we were thinking that we might get a triangle or even a flat for Kiwi. Well, we didn't really get either. In fact, remember on this last Thursday, this spike bar up here, just a total fake out, right? And the market has fallen apart since. This thing was kind of BS in my mind because obviously that was after the SNB, and one has to wonder, we saw a lot of fake outs right there with the Aussie and the Kiwi ripping up towards the highs and reversing very quickly, and one has to wonder if the SNB kind of obviously created some margin calls with what they did in accounts and ended up scaring people out of positions that were all good and well. If that happened, this might be even more bearish because there's nothing more bearish than a bear market with nobody on board. Okay, sentiment figures in Kiwi are very neutral at the moment too, so it's not like we're breaking down and things are extreme. So that's another reason to like Kiwi. Levels that we could find some sort of bounce or consolidation, right? Just possible. These aren't targets. I'm targeting, the first target I'm looking for is 73.90. But levels that you might pay attention to, if we look at the latest range from the December low up to the high that we had last Thursday, you've got the 127 retracement at 75.30. You've got possible lower parallel just below there. Obviously goes a little lower. It's pretty close to 75 tomorrow. You might want to take a 75 peak. The reason to look at levels like this, even if we're expecting a larger breakdown, is just so we're not surprised. If you start to get a bounce off of 75, there's no reason to be shocked. It's something you're looking for anyway. And then what you'd be looking to do is actually identify resistance to sell more, okay, into, sell into strength, okay, put on more size on the trade. At this point, too, this is the breakdown bar, today's high. You can use today's high, which is 77.09, is basically a stop out point, okay, and former lows here at 76 basically now becomes possible resistance, okay, 76 to 76.20. Just a little bit more on Kiwi. You remember some of these charts? If you were an old JS client, I had shown charts for the euro, charts for Kiwi, and et cetera, on just how insanely coiled the euro dollar was. Remember? We showed this. This is what I call Rsi Contraction, and all that is the amount of time that RSI spends between 30 and 70. In other words, you don't have an overbought condition or an oversold condition, and really don't have much of a trend, right? Because you're not going to get a trend without an overbought or oversold condition. We all know that typically strong trends are accompanied by very high RSI readings, and strong bear trends are accompanied by very low RSI readings. And we hadn't had on the weekly chart an overbought or oversold reading in RSI on the euro since 2011. So we had going on 3 years, and 3 years almost exactly, we finally topped here, and then we registered an oversold reading in August of this year, and that was actually more like the beginning of this trend to the downside. So you can see Kiwi right now. Recently we had the biggest contraction, so-called contraction in history in the Kiwi. Okay, That went into September. We registered oversold the next week. Since then, we've been consolidating. So what we have here is basically a extremely coiled market, and coiled when you look at it from a very objective view like this RSI contraction reading, okay, and it basically provides a lot of spring, a lot of fuel for what could be a very large move, right? General rule is the larger the consolidation, the larger the ensuing trending move that follows. And this is probably just this may be the very beginning of a breakdown that takes us much, much lower in the coming weeks and months. Okay, on a daily basis, RSI is actually fairly elevated too. The contraction reading's up to 76. We haven't had a reading that high since last March, when we actually got a break to the upside. Wasn't that clean of a break, to be quite honest. It was more of, obviously part of a topping process that we were looking for seemingly forever. But you get the idea. So looking at the short term, getting involved in this trade, if not already involved in the trade, right? So as mentioned, could find some support for a bounce at 75.30 or 75. Where would you want to be looking to establish a short position or increase a short position? In general, 76.05, 76.20 area. Okay, again, these are former lows. December low, and then you've got the low that we had here just yesterday after a crappy CPI report. The whole thing was retraced, obviously, into this morning, and now we've started to fall apart again. So even though this median line structure that was used to identify resistance up here, even though the structure is completely broken to the downside, the slope is still valid. You still don't completely dismiss it. The breakdown here below the lower parallel is obviously a strong indication that this thing's accelerating to the downside. That's exactly what it means. But the median line could still come into play at some point as resistance. Okay, you can see that it's acted as support before. It's kind of a consolidation here. We had some consolidation here last night. If we end up getting some more consolidation, you could get up to this median line and get 76.20 or so overnight. In fact, this would intersect in very early European trading on Kiwi dollar. And you say, well, how do I necessarily trade that? If you're going to do much better in this game if you're, I think, more actively kind of managing your trades. Give you an example. This was kind of how I traded Kiwi today. What I'll do, it's almost like you're treating it as a scalp on a short term, trading into resistance, okay, and going in with a fairly large position with a very tight stop, 10, 15 pips, so that you're not risking a whole lot money-wise. And once it trades off a little bit, I took some on after 3 pips, okay, just because I had, a good-sized position on, and then took some more off after 38, left the stop just above the high where it is, and holding on to the rest now, okay, for the bigger breakdown. So it's almost like you're scalping the really short term, but you're also using the level to position for the larger move as well. Okay, and the larger move, like I said here, I think is much lower, down towards 73.90 or 73.60, potentially very quickly. And then we'll see how the market trades around there. And I expect the market to bounce around there for a little bit, but we'll see. So that is how we're looking at the Kiwi. Now let's move on to take a peek at dollar yen here. So here's dollar yen. This is the chart I just put up on the SB Squawk Twitter stream, and we've got kind of said this was an area to look for a top, or, if we're going to roll over, we might do it here. For one, it's not just the parallels that we've got here. It's also, you can see within the 50 to 61.8 retracement area of the range of the day, right? We topped up here last night at 1885, 1880 or 1886, 1885 is that big level that we had, just former daily highs and lows. Markets traded off very sharply overnight. We obviously were looking to short up just above 119. Didn't get that, but the this is a place right here to establish a short position. Okay. You can see the price action. These are 15-minute charts or 15-minute bars. You can see how we've got some nice long wicks up here as well. Okay, kind of giving you a safe place to put a stop above, right? So you want to see the market stay below this for the rest of the day. We might have an entry to put in. Pattern-wise, still extremely interested, obviously, in the analog with January of last year, right? So we were short, remember, heading into last week, got limited out at 117, turned around, got long, got stopped out as we made another low that was not expected. Market did do what eventually we thought it would do, which was rip higher. Stopped at 1885, another dip. Now we've kind of recovered. And so we're still, the next big move, if we continue to follow the January last year analog, and I don't see why not at this point, because it has been fairly reliable, save for a day here and a day there. But the next big move you can see is lower, right? So if, say, we're something like, I don't know, say like here in the sequence, we get a little drift on Thursday and then a big decline Friday. And this was actually a Friday last year too. Okay, each big decline last year in dollar yen in January came on a Friday. We had NFP Friday in January of last year, just like we had NFP Friday this year, right? We had a spike higher after NFP, market fell apart. Then we had the next Friday, which was very little actually, from what I remember. And then 2 Fridays after NFP, the market really started to fall apart again. So that's where we are coming into 2 days from now, is 2 Fridays from NFP. See if we get another big sharp decline. And when we look at dollar yen, remember, a super sharp decline, if we can break down through these lows, I think actually sends us on our way toward the 110 area by the end of the month. Okay, that area is it's the range expansion of the December rally. So you would take 115.56 from 128.82, and then subtract that level from the breakdown of 115.56, and that would get you 110.30, which happens to intersect with the lower parallel of the slope. That's been very useful. You can see this slope support extended off the high from last January, got the high, slope extended off of the gap, got the low pretty close to it just last Friday. Okay, so that is kind of what I'm working with on dollar yen. Okay, now on a swing position, the tricky part obviously with dollar yen right now is stop placement, right? On a very short-term basis, trading pullbacks off of these slope lines, that's one thing. But keeping that position for the larger swing is a totally different story. It can be much more difficult. So you want to put your, you want to put your stop obviously in a place that kind of negates the swing move lower, if that's what it is. And at this point, that's probably up, you know, up at 118.85, this week's high. You know, so if we, you know, put an order in to short, you know, up at, you know, 118.10 or something like that, and you have to have a 119 stop. One, don't forget yen pips aren't worth as much these days, okay? So it's not going to be a total 90 pips. It'll be more like 70-something pips, 74 pips, with pip costs about 0.84 at this point. And two, it just means you can't use as much leverage as if you had a 20 or 30 pip stop, okay? All right, so there we are with that. Dollar Mexican peso completely has, you know, done what we didn't think it would do. Ripped higher. Was looking for, you know, again, additional movement to the downside after we had that nice touch overnight. Did not get it. But luckily we're stopped out at 1471 because it's currently trading 1477. Could see some resistance here, but just don't have the setup at the moment. Stefan asking, what is pip cost? So a pip cost is how much a pip is worth, okay? If you trade, well, it doesn't matter what currency that you're necessarily trading in, but, you know, if you're the counter currency, right, the base currency is the first currency in the test. You guys can hear me still? I can hear? Okay, sorry. Just had someone say they couldn't hear. Pip cost, Stefan, is how much a pip is worth. So if what I'll do is I'll pull up a spreadsheet. Okay, so here's how you would determine that. Let's say that your account is based in U.S. dollars. Okay, and if you have base currency, okay, counter currency. So if your account's based in U.S. dollars and you're trading the dollar CAD, okay, you get paid out in counter currency, okay, which is CAD, dollar CAD. Okay, so is each pip worth $1? Okay, no, it's not. It's actually worth however much the Canadian dollar is worth. So in order to figure that out, you have dollar CAD, which is trading. Actually, let's just use dollar yen because I don't trade really dollar CAD that much. So dollar yen, you get paid out in yen, which obviously is not worth, you know, it's not 1-to-1 with the dollar. If dollar yen was trading at 100, it would be the same. It would be $1, but it's not. So what you have is you have 100 divided by whatever dollar yen is at the moment, which is 118. So each pip is worth basically 0.847458. So it's worth, you know, for each dollar, each pip is worth 0.85 regular pips, okay? Now New Zealand dollar, or something that's having the dollar as the counter currency, is always going to, if you're trading in dollars, is going to be $1, okay? If it's dollar Mexican peso, let's use that one. That's a good one, okay? Dollar Mexican peso, let's say today, for example, we had a loss at 1471 from 1464, right? That's 700 Mexican peso pips. Is that 700 pips? Of course not. It's actually Mexican peso pips, and divide that by 1471. That gets you, you can see, 48 pips of dollar pips, okay? So yeah, so pip cost is just, it's how much you're getting, you know, your pip is worth, okay? So if you're trading something like euro pound, for example, and your account's denominated in dollars, euro pound, each pip is worth how much a pound is worth, right? And a pound is worth, at the moment, 151. So a euro pound pip is 1.5 times a regular pip, okay? Alrighty, so let's continue on. Dollar yen, Still like the downside, again, especially given the analog with last year and everything. And to be quite honest, we're starting to see the momentum profile with dollar-yen turn over a bit. Okay, you can see we still have these oversolds down here, and you know, while the rally we had last night, or not last night, but into last night, into yesterday, I should say, it really kind of stopped right at yesterday's U.S. close. But you know, while it was a strong rally, we actually stopped RSI on the 240 to 4-hour chart. Actually stopped right before the you know, the 70 figure. So that's a good sign, right? You know, that's the kind of thing you want to see in a bear market. You want to see the market peak in price with RSI staying below 70, and we got that last night after being oversold for, you know, several lows. So that's a very good sign, and again points to a possible topping process or a much more important decline to come in dollar-yen. All right. Now, since I've talked about the Kiwi dollar and I've talked about the dollar-yen and kind of both of them looking to the downside potentially, it would only make sense to look at the Kiwi yen. Obviously, long-term chart here, weekly chart. You can see we have what could be construed or described as a, you know, as a wedge into the top. Okay, all the way from basically the June 2013 low. All right, it's a contracting triangle, diagonal triangle, wedge, whatever you want to call it. But the point being is that you know, it's a weak structure, okay, that, you know, kind of tends to lead towards a reversal. And this week's action, specifically this month's action, is the best indication yet that we might have something interesting on the downside. So how would we play this? How would we look at this? So here's an hourly chart. We've just broken below the December low. That's a big deal, if you will, breaking a prior month's low. You know, lower lows, lower highs, downtrend. So far we have a lower low than we had the prior month. That's a good start. So where we look for resistance, just like the Kiwi dollar, I'd be looking for resistance first up here at the former low, the December low, which is just broken, 89.96. Okay, and what you want to look and see is, again, we have the median line going on here, right? You want to see, you know, kind of got some pokes here, consolidated around this thing, consolidated around this thing. You want to see if you can end up getting resistance at this former low at 89.96, call it 90 if you want, and in the median line, all right, and be looking to short against 90.40. So this actually offers a better risk, tighter risk, okay, than does the Kiwi dollar itself, because again, with that Kiwi dollar right now, you know, we're looking at potentially resistance up at 76.10 to 76.20, but your resistance or your stop, as far as a swing stop, is probably going to have to be 77.10, 77.15 or something, just because, again, you don't want to place your stop on a swing position where you know, it's completely you know, prone to getting hit and without the trend really doing anything. I'll explain why in a second. I put the Aussie stop as tight as I did last night. But first, I want to get to continue with the Kiwi yen. So Kiwi yen. What's interesting here to note in Kiwi yen is that we intersect here, just like Kiwi dollar intersects overnight at about 2 o'clock in the morning. We actually have Kiwi yen intersect this median line also at 2 o'clock in the morning. Okay, so Kiwi yen, let's say you can get an 89.95 entry on Kiwi yen with a stop at 90.50. At that point, you're talking, you know, 50-something pips risk, and they're yen pips, so they're not, you know, 1-to-1. And the next breakdown level for or target area for Kiwi Yens, probably not until about, this is 88.20 tomorrow. You can see this is a structure that goes through here. The reason I'd put some stock in this is because it crosses through all these levels, okay? You can see even the consolidation around here, right? Let's take a look and see where the 50% and 61.8% come in too, okay? So 88.70 there, 87.40 there. It doesn't intersect perfectly. I take more stock in the parallels than I do the fibs. It's great when they line up perfectly, but in this case it just does not. So, it gives you an opportunity potentially to target this level first, say 88.30 with a stop at, again, 90.50 or so, and an entry near 89.95. Chris Y. asking curious about your thoughts before ECB. Yes, so if you have not noticed, although I'm sure you have, I have not really published any ideas with the euro dollar recently because we have that ECB meeting coming up, right? And you saw what happened today. Within, some stupid announcement comes out and they front run basically their own event, and the thing trades like 1540 to 1650 in a minute and pulls back again. I mean, it's about protecting your capital here too, and it's just kind of senseless, the types of moves that you can get. So what I want to do is I would like to wait for the dust to settle with the euro. Hold on, oh, wrong chart. This was what we looked at this morning. So what I'm going to do is I'm going to wait for the dust to settle as far as the euro is concerned. I absolutely have no interest in sitting with a position in the euro before ECB. My guess is what happens is that the euro ends up spiking down to a new low and taking out everyone that's trying to pick the low, and then ends up staging a massive recovery. Okay. So with euro dollar, I can't sit here and tell you that there's a perfect setup here because there just isn't at the moment. It's one of those things that you'll see it when you see it, and you'll have a nice reward to risk opportunity. But I want to be aware of levels, and with levels, $113.93, right? This is on the swing page, but $113.93 gives us two waves down from the May high when divided with the October advance. Okay, 112.11 is the 61.8 of the entire history of the euro dollar range. Those are two levels to know for possible washout bottoms. Okay, and I do think that's what we're going to get. The sentiment and everything has just been absolutely nuts for some time here. So allow for the washout to take place on ECB before you get, kind of the buy the rumor, sell the news type of deal. I wouldn't be surprised if even before the release the euro gets wiped out, and then on the release it rallies like crazy, just absolutely completely shocking everybody. For me, there's no setup here. Certainly this is definitely kind of cowboy type of trading, something I'm not really involved with. I'll let other people deal with that. And if we were to trade down to 112.11 all the way down there to 61.8 of the whole history of the euro range, you'd have the latest, the high up here in December 17th. You'd interestingly have a 50% retracement up at 1890, which happens to be the open for this week, as well as former consolidation highs and whatnot. So we could very well see a move down all the way to 112.11, keeping in mind 113.90, and then get a move all the way back towards 119. Okay. Now, what might be the best way to approach this is the euro against the New Zealand dollar. Okay. So here's a structure that goes way back to the 2013 high, and you can see that you've got, you know, all kinds of tops along here, right? All kinds of tops. And then after dipping below yesterday's, or dipping below the lower parallel, the market's rebounded. So with the possibility that you have a Kiwi breakdown underway and a euro dollar that's coming into you know, a larger support, we may very well, you know, have some sort of a bottoming process here. One, you have resistance at about 155. Okay, that's the median line for this whole structure. Two, you can envision seeing some sort of pullback, okay, from near here or slightly higher on the euro, you know, ECB event risk. That pullback is something that I think we should probably look at as possibly creating a bigger, you know, long setup. So this is definitely on the fly right here, but what you're going to see is me try to possibly work out. Okay, so more or less at resistance now. That 50-40 area, all right, this was obviously the Kiwi move right here this morning, the breakdown. So if you end up getting ECB that leads to a final low of some sort in the euro, that basically will bring back euro Kiwi to a buy point that you could have had this morning, okay, around the 50-50 figure. What you want to look for there is for support, and then you get double whammy on a euro recovery as well as a Kiwi breakdown, and this could be one heck of a trade. Okay. Again, first resistance probably going to be about 155. You got the euro open there. You've got the median line there as well over the next, you know, day or two. So euro Kiwi, something to look at more so in my opinion right now than just the euro itself. And again, I wouldn't do anything with the euro in front of ECB. At that point, it's just straight gambling. You know, I mean, you saw the action this morning. How are you gonna, you know, place a stop? You know, they come out and say, you know, a few things, and this is what happens. I mean, the euro went from 116.40 to 115.60 to 116.80 in the course of 30 minutes, and now we've retraced that whole thing. So you see what I'm saying? It's not. This is basically serving to wash everybody out. One thing you could have here too, this is getting really nitty-gritty. I don't really recommend this, but one thing we could have is we could have an impulse higher with an A, B, and a final C wave, although it's tough to believe that the euro is not going to try to take out the one more low before this thing rips. In that case, I'd be looking at 1690 as support, though, for the euro. Okay, but don't want to deal with that at the moment. You kind of let the event come out. You know, have your levels mapped out. I'll put this, you know, stuff on, like on euro Kiwi and whatnot tonight. I'll put some stuff up. Say this is kind of what I want to look at. This is what I want to look for. You know, kind of to position for another Kiwi breakdown at some point. And these are the levels in euro Kiwi that might actually be able to, you know, give us some entries for the long side. Okay. Let's see here. What else can we take a peek at? Let's look at, I had a question here from Mark. Sandeep asking, yeah, Euro Aussie similar to Euro Kiwi seems to be holding. Absolutely. I mean, you know, similar. One thing with that, and this goes hand in hand with the question that Mark just asked. Mark just asked about Aussie dollar. So Aussie dollar, again, you know, and we talked about this, you know, last night in the letter. We talked about having one more fifth wave low in Aussie, right? And then if we got that low, we could very well get some sort of a, let me put a chart up that has nothing on it so you can really see how the clarity of the levels. Okay. Remember, what we're really looking at with Aussie here is from the high here back in October. Okay. And if this is a wave 1, 2, 3, 4, okay, then this final deal here is a fifth wave decline, and the risk on that is that you get a low and then you get a rip. So a couple ways to try to figure it out. Where could a low be? 127% of wave 4 gives you 79.60, okay? Well, how about equalities between waves 1 and 5? Waves 1 and 5 would be equal at 79.24, okay? So 79.24 to 79.60 is kind of a bottoming zone for the Aussie dollar, all right? Now, Kiwi itself, again, is just now starting to break down. We've had a reversal here in the Aussie-Kiwi exchange rate as well, right? Aussie-Kiwi, this was last week. I actually put this chart up last week during this webinar, and it mapped out this level as resistance. We did trade into it. Actually, I think it was the next day. This was Wednesday webinar. Next day, we traded into it and pulled off. Well, we just broke that level, and we broke it with a big wide bar. So this very much indicates a possible change in behavior for the Australian dollar against the New Zealand dollar. And keep in mind, we're, you know, coming off of lows that we haven't seen in basically 40 years in this thing, in the process of making, you know, this is a weekly chart, in the process of, you know, kind of making a larger reversal. I want to see what the momentum looks like on a weekly chart. You've got big divergence down here, new low, RSI above 30. So there is definitely the risk that Aussie outperforms Kiwi going forward, okay? You know, don't get scared of the Kiwi short possible breakdown just because Aussie looks like it might be coming into huge support and bottoming. We could have a huge Aussie-Kiwi reversal here too, all right? So I would keep that in mind. So that's why, Sandeep, I would actually stick with the Euro-Kiwi on the upside rather than Euro Aussie. I'm just more bearish on the Kiwi right now, okay? And, you know, some of it has to do with just, you know, well, most of it has to do with the way that Kiwi itself is acting. Again, the breakdown after all the consolidation that we just talked about earlier in the webinar. But, you know, when you look at Aussie Kiwi itself, you know, you see the potential there for a much bigger reversal. All right. And here's another, you know, we have actually changed momentum profile on the 4-hour. When you look at Aussie Kiwi on the 4-hour, you can see us holding down here, holding 30 at the lows, big divergence. Just now on this move up today, we've broken through the 70 figure, okay? What you want to watch for now is to see if Aussie Kiwi, see if it holds, you know, RSI holds at 50 or 40 as the rate, you know, goes sideways or corrects a bit lower, all right? So this is the change in the momentum profile. So with that said, I want to go back to Mark, Aussie. So we talked about coming into a fifth wave low. We had said 79.23 to 79.60 or so. One of those is two equal legs, or sorry, one of those is wave 1 equaling wave 5. Another one of those is 127% of wave 4. And if we look at the weekly chart here, do you know what 79.27 also happens to be? The 50% retracement of the entire rally from the 2001 low all the way up to the 2011 high. Okay, so you've got a lot to look at in terms of 79.20 to 79.60 for a much more important low that gives us, you know, what I think is probably a much needed correction higher. Okay. In the Australian dollar. So, you know, perhaps Aussie Kiwi itself won't be a bad trade. I kind of like to stick with dollar pairs, and if I end up being long Aussie and short Kiwi and puts me long Aussie Kiwi, that's awesome. Might be something to look at, though, on just a trade for itself with the Aussie Kiwi. What else do you guys want to look at? The DAX. Yeah, I actually don't have the DAX on here on this platform, so I cannot actually look at the DAX. What we'll look at is the S&P, though, S&P 500. So here's the S&P. I've been putting these charts up for, seems like we've had this been following the structure for some time. The S&P is having a tough time holding above this slope resistance, right? Each time pushes up, gets kind of slammed back down to earth. Today's poke above was the biggest one. This is kind of another, I guess you'd say, another reason, you know, why it's important, I think, to you know, treat daily closes is quite important, because you poke through this resistance intraday and the thing pulls back sharply. I actually saw something here's what it looks like on the daily, right? You look at this on the daily and you can see, you know, if we close here, you can see, well, this is actually fairly bearish, because you can see all the selling pressure, you know, with these wicks, right? You've got all the selling pressure with these longer wicks up here, wicks here, these wicks here. You know, not exactly the epitome of a healthy looking market. And, you know, bottom line, you do have a downtrend going on here. Low, low, lower high, lower high, lower high. Okay, broadly speaking, you have a sideways trade going, obviously, since December. The big support for this, if we break down, and I see this as a more likely and likely scenario because everyone thinks it's absolutely crazy that we could, keep in mind that actually the S&P 500, the VIX on the S&P, I think it was from 2010, starting at 2010, 2012 to 2014, you had a settlement in the VIX above 20. I think it was 4 times. 4 times in those 2 years. Since, November, we've actually had a settlement in the VIX above 20, 14 times. So that's telling you that things are getting a little more two-way, a little more scary. Okay? Here's, see Brendan talking about the SPX. Yeah, take a peek. I just want to see where this would go if indeed we broke down what kind of target we could be looking at from the latest rally. So you could get targets at basically 1926 and 1880, okay, in the SPX. Bottom line, and what's probably more interesting to us on the near term, is that this thing remains very pressured. Yesterday's high, 2030, or today's high, 2032.75. You know, I would treat that as an important high. We're trading 12 handles off of it already. So, look, I'm looking to the downside here. Today kind of tested that bias, if you will, because the market did penetrate this upper parallel, by a decent amount. But the fact that, we've come off so hard, and if we do close below here in the next 2 hours, that actually is probably more bearish, right, than if we would have just kind of traded up into it in a quiet range. So looking lower in the S&P, okay. This is a great question or comment by Brendan Crowley. Brendan says, could it be a triangle from the on the hourly chart since the 7th of January? Yeah, so you're looking right here, right? Yeah, so kind of like an A, B, C, D, E. It very well could be. Let's see what the momentum profile looks like in the S&P. Okay, so S&P deep oversold. Each rally since then has failed right at, I say below 70. Since then, it's definitely been a range. And this is, Brendan, most certainly what you would expect to see momentum profile look like in a triangle. So it's certainly possible. For our purposes in assessing risk trends here in the in the near term, I think it's more important to understand that we do have a bearish structure, that we could be targeting, say the 1900 area by the end of this month, all right, which would be a heck of a decline from here. That's 120 handles. That's where you get an intersection of the median line as well as this lower parallel that extends off these tops here by the end of the month. So, that makes the case for a possible dollar-yen move all the way down to 110 by the end of January, early February. And, the general risk trends. Pound dollar. Any comment on the FXCM stock crash emergency? Yeah, I mean, I can't really, can't really comment. I'm a market analyst. I'm, a trader. Not going to comment on, what's happening with FXCM. Look, I'll tell you straight up that I have an FXCM account and I have a good amount of money in it. So, if I wasn't comfortable there, then I wouldn't have that money in there. So, that's, about the best I can give you. I don't want to get into a whole bunch of details on it though. But yeah, I mean, just Stefan, understand I do have an account with FXCM and I have, a decent amount of money in there. So, that's a pretty good endorsement, I think. Looking at the pound. So pound dollar, again, here we are, 151, pressing this thing like no tomorrow. Have a feeling that after tomorrow's ECB, we get a little more clarity on some of the European currency situation. We were able to get into that really good entry last week, and we did end up taking 60 pips out of it, with the 150.90 entry and whatnot. But, I like this thing on the upside, but I think that, after last week and what happened with the Swiss, look, we understand that's like it's like a 30 sigma move, okay? But it also drives home the point of not being in the market all the time, right? Time is risk, and crazy stuff can happen. External events can make, huge black swan events occur, and, that can ruin you. So, it's why we don't like to take as much risk in the sense that, we're in the market all the time. So if you're always, have to always be in a position or whatever, what you're doing is you're basically incurring a lot of risk, right? Even if you have a stop in, you don't know if there's some crazy gap or something that happens. So in this case with the pound, yeah, I like the upside. And you just look at this and you say, well, why don't you buy it at that support? Because I don't know if this thing's going to gap down and then close back above. This is the old chart we were working with, and this is still a possibility, right, in which we have a fifth wave working lower right here, right, 1, 2, 3, 4. You could get something like a, 1, 2, 3, 4, 5. You can get something like a diagonal. If we were to get something like that, then we'd have a great opportunity to buy pound dollar really cheap, especially when everyone would expect this thing to really fall apart. But watch what happens with the pound, because this reminds me just right now as I look at this, it reminds me of what we saw at the Kiwi yen recently, but it's the inverse, okay? And what I mean by that is if you have, this looks like a head and shoulders continuation pattern, right? Okay, just, you know, a high, a higher high, a lower high, neckline's the low, right? So it looks telegraphing like this thing's going to break and fall apart, right? Not necessarily. We don't know that for sure, okay? And here's the Kiwi yen example. Kiwi yen just did this. It was a bigger pattern, but you can see it right here. Low, lower low, higher low, turn higher. This thing looks like it's about to explode, right? And it falls apart. Okay, now this is actually a signal in the opposite direction. Okay, the fact that we failed to, you know, confirm this pattern on the upside, and that's another thing that I want to drive home, is be really careful about predicting the way a pattern's going to play out. Sometimes it will, sometimes it won't. You know, when it does, and you're really in tune with the market, then you can really trade, you know, exceptionally well, high confidence, and you feel really good. But, you know, if you would have gone long here, you know, just giving up, you know, a stop down here, you know, at the end of the day, you could argue that reward to risk would have been good, but you're still at 150 points. You know, so the fact that we had this, what looked to be a very well-defined continuation head and shoulders pattern on the upside in Kiwi yen, the fact that it totally fell apart this week, tells me it's a strong signal in the opposite direction, okay? And that's why we'll be looking tonight to get a, you know, a poke into, say, 89.80 to 89 for, you know, I'd say a short against 90.50 for continuation on the downside. I have a few more questions. Can you look at the bond? Unfortunately, I don't have that on this platform, so I apologize. You know, in the future, we'll probably be looking at getting additional, you know, data feeds and maybe offering, you know, more services for different markets. Tuttle says, "What's up? How you doing? For your short-term trades, use the price action within the trading sessions." Yeah. So, you know, to give you an example on, talk about the Kiwi trade, right? This morning. Here's a Kiwi trade. You know, this one, look, I actually started shorting right here when we had this little doji on a 5-minute chart. We were right at the level, 77. I was like, you know, I can't believe we got it, 77. Put a stop at 77.20. Now, it spiked up to 77.09. And then you got a huge reversal here, and everything fell apart. This was on the CAD, I guess the CAD rate decision, and people freaking out about commodities and everything. So, you know, we did start falling apart there. But, yeah, I'll use, you know, key reversal bars, you know, long wicks. You know, just right now, as we've been on this webinar, you know, I put out this chart here, and this is a 15-minute chart. And if you look at a 5-minute, well, 15-minute, actually, you know, you had a high wick up here. Okay, you had another big wick here. So, I mean, this gives you a good reward to risk, right? Selling a 118, 118.20 stop, okay, already at 17.80. So, yeah, it definitely is about using price action for entries on shorter term. Sometimes I'll obviously put in the orders. The reason for the Aussie trade last night when I put in at 81.90, there was just a lot of stuff at 81.90, okay? We had all these former lows, former high, and we had the Tuesday high up here at 82.17. This decline to me was just a sloppy mess, so I didn't have a whole lot to work on, and I didn't want to risk above Tuesday's high, right? I guess this could end up being a diagonal, what have you. At the end of the day, Aussie, like I said, still think that we're probably working in a fifth wave lower that ends near 79.20 to 79.60. After that, you could go to much bigger pop. Okay. Dollar knock is a question we've got here from Craig. Like dollar knock is a larger reversal possibility still. Again, this is the longer term weekly chart that we put up last week in one of the that we put up in one of the swing updates last week. You see this huge spike bar we had here at the very end of December. We had additional upper wicks on the weeklies the last couple weeks. Okay, eventually this thing is going to come off hard, basically like being long crude oil. And as far as the short term's concerned, still following for resistance, basically up at these levels, right? We had looked, and we kind of looked for, what was it, 772 last night. We didn't get it. So as we head into tonight, 770, 767 might be an area to get into. Basically just looking for resistance up here. I mean, you still have daily reversal resistance at 769.60 as well, right? NOC's been pretty spiky the last few days. So Tunnel asking, well, just here to sum up, Craig, what I'm on dollar NOC is, with the bigger picture, I am looking lower, okay? I'm looking lower. I'm looking towards 731. That's the big spike, weekly spike low down here in dollar NOC at the end of December. On the near term, 731 also, you've got some support down here too from longer term median lines that come into play. But on the near term, resistance basically is from, say, 764 to 770. I mean, it's been the same level we've been looking for a few days now. It's just been very choppy price action. So it's slowly kind of trying to make its way lower, it seems. Could be a period of nesting, if you will. Could be an A and a triangle period before this thing breaks down. Don't have exceptional clarity on this at the moment, but reward to risk, I think, on a swing basis is to the downside on dollar NOC, given all those huge spike bars that we've seen over the last month or so in dollar NOC. Finally, here we have a question, Tuttle, do you wait for price to put in a session range and break it before entry? So by a session, you mean like a whole day or an hour or like a 4-hour period? Asia, London, right. So a lot of people I know can trade off will trade off 4-hour bars. The way I look at it is this. You've got different ways to go about things, right? You can use strictly price levels, okay? So let's say that I was expecting resistance at, let's go back to the Kiwi trade this morning. Let's say I was expecting resistance at 77 as I was talking, because we had the, sorry, we had the, the 77 area kind of highlighted as resistance, and I could just put an order at 77, right? But the market was fairly far away from there last night, so at this point we're still at a range too. We're coming into the range lows, and putting an order at 77, you risk kind of getting, you don't know if this is going to hold or not, right? Then you can add price action to it. So if you look to do that and you wait for the market to stall at 77, then you can start putting in short positions with a really tight stop, because one, you have that level marked as significant anyway, okay? Two, the market's showing you there's resistance there because it traded up and then stalled or pulled back or whatever, okay? Even if you did it here, 76.70 with a stop above the high, which would have been 77.10, even there, you're putting in a 40-point stop or whatever. Now, this doesn't happen all the time, complete fall apart, but you get the picture. So no, I don't necessarily wait for a close of London or Asia or whatever. It's different entry periods for different markets. I mean, I'll prefer to look for the entries. I obviously, I send out the charts every night that I'm going to be looking at, right? Whether we've got like some highlighted levels in there. We got what we're looking at. Former lows would intersect with upper parallel throughout tomorrow's trade, beginning just before the U.S. Open. So that's exactly what we were looking for. And once you have all those things come into line, it gives you a little more confidence to maybe enter the trade, and using price action, okay, to finally trigger that trade is a pretty good way to go about things. Okay. So Tuttle, to finally, answer your question, yeah, I mean, good. You said thanks, very helpful. That's awesome. Good to hear. Yeah, I don't wait for the total, the session to end, right? Get some wicks at the levels that are outlined. Again, you can, as I talked about earlier with the Kiwi trade, you can go in a little heavier if you're going to have a really tight stop as well. Take some off after 10 pips and then leave the rest on. At least if you get stopped out at that point, you're probably a wash on the trade because you had some on in the first place. It's almost like a two-tiered trading strategy, like you had, a short scalp to take some off, and then you had a, the swing position to get into for the larger move if you get it, right? Okay, let's take a look at gold. Had a question on gold. Stefan also says Euro Swiss technicals seem worthless at this point. Well, wouldn't necessarily, say. I mean, yes. Look, Euro Swiss technicals at the moment. Yeah, it's going to be fairly disaster. One, I'm not too interested in trading Euro Swiss. Haven't been for years. Mike and I both have tried to tell people to stay the heck away from that thing because it's not, you have no control over something like the S&B, right? I mean, there's just no market for it. So, with the Swiss franc itself, dollar Swiss, I haven't been trading it, but I've been keeping it up because I want to know how it's moving because it's been a big story in the market. And I have all the fibs on from the move that we had last week, so I know where the 38.2 is. I know where the 50% is. To give you another, I have, look at the lines I have on here as well. I've got hourly reversal. This is hourly reversal resistance right here. Okay, that was the high yesterday during Europe. It was at 87.73. It was resistance throughout the rest of today. It was resistance yesterday afternoon session. It was resistance today during Europe. Okay, almost to the tick. We also have some hourly reversal support right here. Right? This wasn't as good, but you get the point, right? 85.80, okay? We did dip below it all the way down to 84.90, extremely volatile right now, but then we're back above. So what you'd be looking for now on dollar Swiss is support at 85.65, which was the hourly close here at the low at 10 a.m. That's now hourly reversal support. So, if so inclined to trade this volatile range, I guess you could do that. Not, my style at the moment, but yes, this could offer an opportunity, to buy 85.65 with maybe an 84.90 stop, 70 pips of risk. Remember, this is a very volatile situation. God knows what kind of comments could come out at any time, sending this thing one way or the other. I'm not necessarily all about it at the moment. Would rather stick with the setups that we're looking at, particularly in Kiwi and yen, Kiwi yen, et cetera, et cetera. So, could certainly get some sort of this is more than anything, this is just an entry technique, right? Hourly reversal levels, okay? If the market were to hold up here and come back and test this during Europe, maybe you get an entry off of it. Not something I'm really advocating at the moment, but the reward to risk is definitely there, though. Okay, we're talking that, resistance probably doesn't start really until 91.20 up here to the 38.2, which was the high also on the 15th after the whole deal happened. So might want to take a peek there. But again, you're on your own on that one. Finally, let's look at gold. Okay, so gold, first things first, this whole zone, right, all this resistance that we had, okay, traded around that, and this action that we had out here, on this, what was that? It's the first day of the year. Okay, on January 2nd, we had a big spike reversal bar here. So that, for one, is, was a nice indication of something. And Mike's been writing a lot up on gold recently this year, and kind of he was bullish early. He got a good call on gold. So as we look at it now, one, we broke head and shoulders pattern. Okay, it's what it is, shoulder, head, shoulder. The target for this pattern happens to actually intersect the exact 1350 area, 1345 to 1350, which happens to be, of course, the July high. Okay, gold's had a run, and it's definitely prone to a pullback after the run we've had. The level I'd be looking for support is probably 1256. Okay. Now, again, with ECB tomorrow, you're going to get a volatile session. Okay. I would not be that surprised to see gold get slammed from pretty close to here. We did come very close to hitting this upper parallel as well. Okay. Up near 1310. High today is 1307, and we're putting in a reversal bar. Trading at the highest level we've traded at since 8/15, okay, August 15th. So, trading up near 5-month highs, basically, and to the 5-month highs almost exactly, and putting in a reversal bar like this warns of a pullback in gold. So here's how I would look to play gold. If you're looking to play gold, look for a pullback from here, but look to buy weakness into, say, 1256. 1256 is one, the October high, former resistance. You look for it to become support. Two, it's also the median line tomorrow, the exact level. Okay, it's also the low here on the 16th. That was last Friday. So, you'd kind of wipe out all of this week's gains, but to me, I think it'd probably just be a washout before you head higher in gold, because the breakout is very much underway. It'll at least give you a very good, opportunity to enter gold. And, you got to think that if this thing gets slammed down because of ECB or whatever, those moves are oftentimes very, temporary. They don't last very long, right? It's a liquidity move. It's a news event move. Buyers step in. It's an uptrend at this point, and step in at a good price. So 1256 support. We're really close to resistance. We're putting in a little reversal day. Near-term weakness. Continue higher after the dip. All right. So that is it for today. Awesome. Thank you for attending. And again, I'm steering clear from euro, for right now. Okay. I think we're going to have some really good opportunities as we get into tomorrow and after tomorrow. Once we get this ECB out of the way, we may, set the stage for a bigger rip. Okay. As I'm thinking kind of, right now as I look at gold, we could very well think about gold and euro together getting a little slam down on a general dollar rally on ECB, okay, and then that puts in the euro low, puts in the gold low, puts in the Aussie low, and then they all rip together. I don't know. It's just a nice thought. Might also have a chance to sell dollar yen on that too. Okay, so tomorrow's lining up to be fairly big. All right. That's all, guys. Thank you so much. Again, be back with next Wednesday's midweek webinar. In the meantime, we'll be on the squawk, and have a great rest of the week.